Sanjay Chawla, Chief Investment Officer, Equity Baroda BNP Paribas Mutual Fund, to share his views on flexicap and multicap approach. He has over 33 years of experience in fund management, equity research, and management consultancy. In his previous assignment, he has worked with Birla Sun Life AMC as Senior Fund Manager Equity, managing various schemes with different strategies. Mr. Chawla has also worked as Head of Research with SBI Capital Markets in various capacities in the equity research space in Motilal Oswal Securities, IDBI Capital Markets, SMIFS Securities, IIT Invest Trust, and Lloyd Securities. Please put your hands together for Mr. Sanjay Chawla.
So good afternoon, everybody. I have a tough job. After such a sumptuous lunch, I need to make sure that you guys are awake and tentative out here. So we've come from a very high level after Swamiji has spoken. I'm going to be more on the grounded level, and being an engineer, I'm going to throw a lot of numbers at you. So it's very important that we are right out here. But first of all, I would like to congratulate the entire Wealthy Nivesh team on achieving a milestone which is making waves in the distribution industry. Wishing you more success and celebrity records in the coming time. I was very impressed with the Wealthy Nivesh tagline: trust, simplicity, and growth. These are mantras that I know are stepping stones for success in the financial world. Thank you for coming down on a sunny Sunday. I think we've had a lot of rains the last week, so it's a nice weather, and you chose to come down here. And I would also like to thank Ankit and Aditya for inviting me to share my thoughts on the equity market. I'm going to make a brief presentation, and if time permits, and I think I would encourage you that you ask questions later on. So a ship in harbor is safe, but then that is not what the ships are meant for. They're supposed to traverse the sea and oceans and ultimately reach their destination. Similar question arises with our money and wealth at this juncture of the market. The biggest mistake that we can do when the market's at the peak is do absolutely nothing. So what I hope at the end of this session, you would do something about your money and wealth, whatever it is. So let me just outline what am I going to be talking in my presentation. I will talk a little bit about what are market return characteristics in the past 30, 40 years, and that should give you a flavor of what's actually happening. One niggling question that you would actually have is, look, we are at the peak of the market. Should you be investing at this stage or no? I intend to throw some points for debate, and how are we actually looking at the equity markets in the years forward? And I'm deliberately going to stay away from the very simplistic argument of valuations. That's an easy argument, but nonetheless, if Aditya throws up questions, I'll try to defend in the Q&A session. And then since I'm talking about representing my company, I do hope to briefly talk about it in a minute or two about my company and the couple of products that you could really look at. So let's talk about the equity markets and the returns or the anatomy or the past trajectory. And since it's been an appraisal time in the corporate world, and I'm sure there are people from the corporate world, the bell curve is something very familiar with us, right? And I see a lot of smiles on the audience. So since it was a topic of hot debate, I just was wondering if I could actually fit in the equity market returns of BSE Sensex in a bell curve. And what I've got out here is exactly that. But let me give you a standard textbook definition of a bell curve. And I quote, a bell curve is a common type of distribution for a variable. In this case, we are looking at a 1-year return of BSE Sensex over the past 42 years. So what we have is the annualized return bracketed in various time range, various percentage ranges. The year are boxed in each of these boxes. So it's a very beautiful bell curve, and this is for, I am sure we don't have any HR personnel, otherwise they would love this kind of a slide. I have a couple of takeaways from this, and I'm sure you also would have a couple of takeaways from this. The average return over the 40 plus year history, and we have 42 years of data point right from 1979, the average equity market return is between 12.5 to 15%. The reason why I'm saying it's 12.5 to 15 because within my office we had some mathematics students who said that average is not the right one, median is the one. So I have tried to please both of them. So it suffices to say that we are in a double digit at 12.5 to about 15% return over the period of time. And honestly, this actually corroborates with what is there in my bell curve. The peak of the bell curve represents the highest frequency of the data out here. Well, there are years, and the second point that I would like to make is, while there are years when the returns are negative, which is on the left-hand side, but what is important to note is the number of years that we've had in terms of the positive return is far higher than the negative return. Another point that I would like to impress upon you is the absolute return that we've also made during the absolute outperformance is far more than the negative returns. I would love to have your comments on this graph, maybe in the Q&A or when the audience question is there. In equity market, there's an old adage which says that timing the market is not important as the time in the market. I'm sure you are all seasoned investors and know the importance of staying invested for long term. However, I'm still going to impress this point. What we have out here is a very busy slide. And every year when I update this slide, I'm really amazed by the consistency of the returns. Let me explain the slide to you first. The table captures the return for a calendar year over various time periods. How do you interpret it? The 11.9% return that you see on the top right-hand side represents the return of Nifty over a 10-year period for the period ending 31st March, December 22. Similarly, the figure of 4.3 at the bottom right-hand side, just above the 10-year GSEC, represents the Nifty return on a 1-year period for the period ending 31st March 2022. So what we have is a period. On the y-axis, we have the number of years. So if you look at it horizontally, that's the time period in which the Nifty is given a return. The table has been color-coded. The red represents the negative return. The light green highlights the return of Nifty in the years in which it has not beaten the inflation during that time period. The dark green represents positive return beating the inflation. One obvious observation is that in the long run, equities have generated wealth by beating inflation consistently. So the one which you see on the top right-hand side corner is the one that you should be focusing. It has consistently beaten out there. The second key point that I would like to make is as you go up, as the number of years increases, the volatility reduces if you stay invested for a longer period of time. If I had invested only for 1 year time period, every year for the last 10 years, the chances that you would have made a return which could range from, that's the horizontal line at 1 year, from minus 4%, that's in the year 2015, to as much as 31% in the year 2014. That's a wide range of about 35%. Let's look at if you had invested for 10 years and stayed there, the return range would vary from 5.5% to close to about 18.4%. The actual range is only about 13%. Thus, for achieving one's financial goals with a higher degree of certainty, one needs to stay invested for a longer period of time. So let's talk about the key point which keeps troubling all of us at this moment. And every day we have the newspaper headlines screaming in our faces that market is at a new high. And this is contrary to what is actually happening in the global financial market. Yes, I do agree that the markets are behaving differently from what's actually happening in the global market. And in my opinion, they're behaving very rationally. There are many plausible reasons and explanations for the same. There are many things on the economic front that we are doing right as a country. Our inflation is very much under control. Our economic policy on the ground has laid a strong foundation for future growth. The demography of the country are more favorably placed than any other country in the world. I can list many more positives, but I guess you get the trend. Before I talk about investing at the peak, let me remove a wrong notion about the market that we've risen too fast too quickly. If I look at it statistically, the last 5,000 points that we moved, that is from 60 to 65,000, is probably the slowest that we've ever seen in the history of the market that we've seen. One of the slowest that we've seen. So what I've captured out here is the Sensex data right from 1979 when it was there. What I've got here is at each and every peak, what is the return that you would have made if you had invested at one peak to the next peak, and the time period that we've got out there. So starting from 1979, 4th April, we hit the first peak in 1982, return of 29.5% from one peak to the other peak. When we were at the first peak, we didn't know where was the market headed. We had probably the same questions. We can go on and on and on. And during this time period, we had a lot of events. We had multiple elections. We had monsoon failure. We had a couple of scams out there, financial scams. We had the PIX crisis. We had the Euro crisis. And we keep debating about everything. So in a growing economy, it is natural for earnings to grow higher and higher. This has resulted in the equity markets hitting a new high over the last 42 years. And there have been 10 instances where this has happened. That's an average of one new high every 4 years. What we have in this slide is the CAGR return if you had invested at the peak of the market and stayed invested till the next peak, and the number of months taken for the Sensex to move from one peak to the other peak. What we had done out there is graphically captured the numbers to make an impression. This is how the actual Sensex number is depicted. This is the actual index. Due to the scaling, we decided to show the previous slide, but if I've pinpointed exactly at the various places, how from one peak to the other peak, you had the kind of return you would have made. Let us look, if we had invested at the peak of the previous peak and stayed invested till the new peak, how much return would you have made? This is exactly the current dilemma that you as an investor would be facing. Let's look at all the 10 instances. Of the 10 peak to peak investment, there are 7 instances where you would have made a CAGR return of more than the long-term average return that the market has generated. Let's look at the other 3 instances which are highlighted in red, which did not make it to the above average grade. So case 1 was post-Harshad Mehta scam. The market gave a return of about 4%, and it took almost 94 months for the market to come back to the previous peak. Mind you, if you look at the previous peak, we got a return of about 98% in a very short period of time. And I would tend to believe this also coincided with the Y2K peak. Yeah. And there was a lot of consolidation which was actually happening in the markets. The second instance was the period post the global financial crisis and the PIX crisis, that the market gave a return of just 5%. Finally, between 2015 and 2020 peak, we had number of local issues. We had the GST introduction, which disrupted the economy. We had DeMon, which again disrupted the economy. We had the ILFS crisis, which was, according to me, a huge crisis, but very well managed. And of course, we had the taper tantrums, which kept the CAGR close to about 7%. It is interesting to note that the current peak that we have seen in the market right now, it has given a return of 13.6% and has taken 42 months to come across to the new peak. Both return and time periods are more or less in line with the long-term averages. So there are two fun facts that I would like to point out here. Despite the lower than expected returns in the 3 time periods, it's very interesting to note that each of these periods are reporting a higher CAGR return than the previous peak. We had 4%, 5%, and 7%. Fun fact number 2, the minimum time taken for one peak to the other peak is 20 months. That's the Harshad Mehta scam. And the maximum time it has taken is, I think, close to 8 years, which is the 94 months, which we've seen. This average time taken to establish a new peak really ties in with my next slide, where the economists believe that Indian economy is expected to double in the next 7 years. So let me just talk briefly about what is the actual outlook for the economy per se. I'm a strong believer that history repeats itself. As a financial analyst, it is my job to identify the global trends or patterns over past and see how they may be relevant to the Indian financial markets in the coming time. Today, I would like to share some of the insights that I've gained from studying the various equity markets. And the first thing that I've seen and studied looking at all the global markets over the past 70, 75 years is the moment the per capita income goes up from US dollar 2,000 to 5,000, there's an inflection in the equity capital market. So let's look at various countries, and mind you, I've taken just 3 countries as an example. You can go back and check for all the countries, whether it's developed or developing or which have come forward in the last 20, 30, 40 years. Just for the sake of convenience, I've taken 3 countries and benchmark what is the return that they have made. These countries are Singapore, Korea, and China. I would like to draw your attention to the time periods so that there's a little bit of a sequencing out there for each of the countries, and you would probably recollect how each of these countries have actually developed over a period of time. Singapore, the per capita income increased by 2.4%, by 2.4 times in 7-year time period. Korea's per capita income grew between 1983 to 1989. It went up by 2.6 times, again from $2,000 to about $5,800. China's per capita income went up from about $2,000 to about $5,600 in 5-year time period. The time taken for all the 3 countries under study in terms of doubling their per capita income is between 5 to 7 years. During the same time period, the return of the underlying index, and I would like to draw your attention to the table below, where I've captured one of the returns. Just for clarity for people sitting behind, I'm just going to read out. The long-term return that China has given the equity market since inception is just 10%. Korea has given 8%, and Singapore has given a return of 5%. However, if you just slice the data during the time period where we've seen exponential growth in the GDP per capita, the inflection point of 2,000 to 5,000, the return in China is 11% as against 10. And this is, we are talking about CAGR return over a long period of time. In case of Korea, the return is 33%. The equity market, underlying equity market gave a return of 33%. Similarly, for Singapore, it is 12%. My explanation why the equity markets do well during this phase is very simple. At about $2,000 per capita income, which is about 16.5 to 17,000 rupees, a large portion of the income actually goes into necessity consumption. That's your food, rent, etc. As the income level rises, the necessity expenses don't rise in the same proportion, right? And hence the amount available for discretionary spend increases. This spend on consumption has a multiplier effect on the economy. This in turn leads to improved demand, resulting in higher earnings and in better equity market. Let me nix a question, and I'm sure based on looking at the data of China, one would say that, look, China market has not really done well. So how is it actually supporting your argument? Just to remind you, China's growth is actually led by capex growth, or infra-led as we say. Chinese economy is more capex heavy and less consumption heavy. And hence, despite the per capita income increase, the Chinese economy did not have any consumption boom or the multiplier effect in its economy. And that was very minimalistic out there. All this is fine. What does it actually mean for the Indian economy? And how does it actually help the Indian investment? So what we have captured out here is India's per capita GDP, right? We are currently at about $2,389. According to me, India is on the cusp to take off. If I take a nominal GDP growth of 10.5%, which is in line with the last 15-year averages, we should take about 9 years to double the per capita GDP to about $5,400. I'll be really disappointed if we take that long. If I go by the history, most of the countries actually went up from $2,000 to $5,000 in a time period between 5 to 7 years. So either my assumption is wrong or the history has to be proved wrong. My sense is the way things are looking, we'll probably do much better than what we have done historically. My personal take is India should do much better than the rate at which we have grown in the last 15 years, and this is something that even my previous speaker was alluding to. I've taken a nominal GDP growth of 10.5%, which is nothing but 6% GDP growth and 4.5% inflation. We can challenge these assumptions. My sense is India's actual potential to grow in GDP terms is about 7.5. And if that's the case, you should see much faster growth in the per capita GDP. According to me, this is actually the golden era for the consumption economy as we speak in the next decade. My investment thesis is we will see a much higher multiplier effect on the Indian economy because of this consumption boom. With India's per capita income entering the golden phase, we have examples of China, Singapore, Korea, whose equity did much better than the long-term averages during this period. We can expect the same from the Indian equity markets over this time period. Just to recapitulate, the Indian markets have delivered a return of between 12.5 to 15%. Need I say anything more? What to expect in the coming decade? So let me just quickly talk a little bit about my AMC. So Baroda BNP Paribas is a joint venture between Bank of Baroda, and I think Bank of Baroda is a very familiar name. It's been around for more than 70, 80 years, present in every nook and corner. BNP Paribas is a large European AMC having strong presence. Both the partners decided to come together, and what we call the whole is greater than the sum of parts, and we are seeing that in action as we speak. Both of them are equal partners. There's a technical part where Bank of Baroda owns 50.1%, BNP owns 49.9%, but in terms of board representation is virtually equal. So the core philosophy that we have when we invest is that we believe that the companies create wealth and it's not really the markets. So it's very important to understand how do we identify the companies. There are three pillars that we look at. We look at businesses, we look at management, and we look at valuation. This is what we call the BMV principle. When we are looking at businesses, we are looking at not only the moat that the business has when we are investing, but we are also looking for a change, a positive change in the business side. When we are looking at management, we are not just looking at the corporate governance side, we are looking at leadership in terms of their ability to manage the various cycles. And valuations is something that we focus on, and within that we follow what is called a GARP philosophy, growth at a reasonable valuation. That's how we go about our investment. In short, we look at identifying superior businesses with strong management and reasonable valuations. So I've been told to talk a little bit about our investment strategy or what has worked with us for the last 1.5 years. The merger's been effected since last 1.5 years, though both the AMCs have been continuing for a very long period of time. We follow what we call the 3 C's. These are the themes that we've invested in. We looked at credit growth. We believe that the credit growth would be picking up. The valuations were very attractive. And hence we were overweight on the banking and the financial sector per se. It's done extremely well in the last 12 to 14 months, and we continue to be excited about it. We continue to believe in the consumption side of the story, not only just the demand, but in terms of the profitability. And we do believe that the capex cycle in the country is for real, and we will continue to see great investments being made, and we hope to capture all of it in our portfolio. One thought that I would like to leave around is on dynamic asset allocation. This is a product which we are very proud of what we have created out here. Of course, Chintan spoke about the category that he's created out there as an AMC. What we have is a unique situation where we actually capture most of the upside from the market and protect your downside in this particular product. And the important thing is we follow a system-based approach while we're investing in the volatile market. So what are the advantages of dynamic asset allocation, and especially the Baroda BNP Paribas Balance Advantage Fund? It's a model-driven net equity allocation that we have. So there's no subjectivity involved in terms of getting carried away by greed and the fear in the market. We take multiple fundamental inputs for deciding in terms of the way we're going to go about allocating the net equity. We have a very rational way of approach because we've time tested this model with almost 18 years of history. We don't believe in timing the market, and there's a natural balance between the debt and equity, and that actually helps in terms of optimizing the return. And the reason why we've chosen debt and equity is because there's a very low correlation between them. And of course, there's a monthly rebalancing, so it is contemporary in terms of asset allocation. So just to end, and this is a quote that I would like to leave you with, and I'm just going to read it out. You get recession, you have stock market declines. If you don't understand that's going to happen, then you're not ready. You won't do well in markets. Thank you so much.
Thank you for those amazing insights on FlexiCap and Multicap, sir. Request Aditya to please continue the session with Q&A with Mr. Chawla.
Yeah, thank you.
Thank you so much, sir, for such a comprehensive presentation. Actually, I was going to ask you about your balanced advantage strategy because it's been coming consistently in the top quartile range. So you've actually answered all the questions. I have just one question about this multi-cap versus flexi-cap approach, wherein most of the flexi cap strategies do carry about 60% large cap exposure, wherein multi cap has a balanced allocation strategy across large, mid, and small cap. So, how do you see mid and small cap sector or mid and small cap companies going to play out in the from a long term horizon, from 3 to 5 years of horizon?
Yeah, thanks, Aditya. Thank you for that compliment about Baroda BNP Balance Advantage Fund also, and for bringing it to the notice that yes, it is done well. And the reason why it's done well is because we follow a very systematic investment style and approach, and where the model determines what should be the net equity allocation, and the investment manager has no option but to follow it. It's time tested. We've checked it over a 18-year history. Plus, we have a 5-year of actual performance history, which is done well. While your question in terms of multi and flexi cap approach, a multi cap, as mandated by the regulator, we have to have 25% invested in small cap, 25% in mid cap, and 25% in large cap. The balance 25% can be invested in any market cap category that the investment manager decides to invest. What we've been running it of late in the last 6 months is our allocation to mid and small cap in our multi-cap has actually increased. Historically, we were running it with 26-27% in mid and small cap each. We've actually increased it to about 30% each. Unfortunately, in case of first, let me talk about the flexi cap. In flexi cap, depending upon the investment manager's view, he can allocate 0% to small cap, 0% to mid cap, and everything to large cap, or in any proportion based on the view that the investment manager has. So if he's very excited about mid cap, he can have 100% allocation to mid cap. Unfortunately, the way the industry is positioned in terms of the size, because of the higher size, most of the flexi cap guys are running their portfolios predominantly large cap. They have about 60 to 75% in large cap, and it's only a small proportion that they have in small and mid cap. So maybe it's more due to the size constraint that they are running it in that manner. Fortunately, we don't have that kind of a restriction. We also run a flexi cap fund. We started off with about 75% in large cap, and that's the mandate that we had, because within 30 days, if you have to deploy all the money that you've collected. But gradually and over a period of time, our mid and small cap exposure has gone up to about 35%. So large cap is a lot lesser than the mid cap. My sense is we'll probably be increasing the allocation to mid and small cap. And the reason why I believe that is the vibrancy that I'm actually seeing in the mid and the small cap companies in terms of performance, in terms of the actual outlook, demand outlook, and in terms of valuation is actually giving me a lot of confidence that they would be doing well. There's no doubt that in the last maybe 3 months, mid and small cap have done very well. Maybe they can consolidate at this stage as we speak, but the potential that we are likely to see in the mid and small cap is far higher than what we've seen in the large cap.
Thank you so much, sir. Any questions that we have from the audience for Mr. Chawla?
So, sir, during our research now, we find out that if you look at flexi cap, so the benchmark is BSE 500, long-term return of 15%. But if you look at all three indexes separately, small cap, mid cap, and large cap. So large cap, long-term 15%, mid cap 17%, small cap 19%. So if I have a multi-cap portfolio, meaning where all three have got allocation, the average return will be 17%. Assuming that over and above that, we have 4%, 5% alpha generated by the fund manager, is it a fair expectation that if you have a 4 years, 5 years kind of horizon, such kind of a strategy can generate 20% kind of returns?
Sankit, you're putting me in a spot and asking me to commit a number. But, to be fair, mathematically what you said is correct. So I won't deny that. Uh, it will also depend a lot in terms of how the investment manager makes the allocation. While we've talked about the index level, uh, while the small cap index has moved up by about 30%, but I know there are a lot of small cap stocks which have done extremely well. And the flip side is there are stocks which have not really moved at all. So when you're making an allocation of 25% or more in a multi-cap, it's also important to see where are you allocating in terms of what sector. First, you need to take a call on what is your view on the market, okay? And then you need to say, given that this is your view in the market, what kind of a beta you would like to have, and given that beta that you would like to have, what sector would you like to allocate? So let me just give a small example. Supposing my view on the market is very positive, a typical FMCG stock is relatively low beta, okay? So the chances that I will have FMCG stock in a falling market a lot more for my allocation is going to be very high. However, if I'm looking at a bullish market, the chances that I'll have more mid and small cap banks which are also high beta in my portfolio would actually increase. So that's the way I would actually decide what is the fund that you should be looking at. But as an investor, 2 or 3 funds that I would actually look at is the Balance Advantage Fund, which is, you really don't have to make a decision in terms of the asset allocation. It is run as a multi-cap. You'll have large cap, mid cap, and small cap exposures. And if you go back into history and check our multi-cap, we've actually gone very high on our mid and small cap exposure also. So that's the way I would look at it. That's one fund that you would look at. And the second one is, of course, your multi-cap, where there's a defined allocation where the investment manager does not take a call in terms of what should be the allocation to each of these categories, because it's predefined. There's a minimum which is there. So the error which you're going to make is not really the error. The allocation that you would make is only on the 25%. So to that extent, you're going to be much better off in a multi-cap fund.
Thank you so much, sir.
I have a question. We all are here, sir, and I attribute that fact to the governance of last 10 years with the present government in place. Suppose, hypothetically, now in 2024 we are heading towards the election. So all these, calculations and expectations of the charts, if at all, I hope not, but if at all, this government doesn't come into power, then how the mutual fund industry and the overall economic growth and the equity markets, what do you think? What are your views on that? How is it going to affect the investments if people make today, thinking that we are at the lifetime high, and all of a sudden we have that kind of disruption?
So I think I've been in the equity market for the past 32 years, and I've seen all kinds of government. I've seen what is a khichdi government. We've seen guy says, this is my dream to become the prime minister, and even if it's for a day, let me become the prime minister. We've seen very high majority government after the assassination of Mrs. Indira Gandhi, and we've seen the economic performance out there. I've seen the gold crisis also when Manmohan Singh and Narasimha Rao were Narasimha Rao was the PM and Manmohan Singh was the finance minister, and we had to pledge the gold out here. So the return that you're seeing right now is not of just because of the period that we are really discussing of the NDA government, which is of the last 7 years. Okay, in the last 7 years, I think there have been a lot of structural reforms which has laid a very strong foundation. The return that we've got is not very high this time. And I deliberately shown that single slide where I had sliced the performance to show you the actual return that we made earlier was about 20% and what we're making right now is about 13-14% only. I don't think any government coming in is going to change or derail the entire process of economic growth. The resilience of the Indian population and the demographic is so strong irrespective of whoever comes, it does not matter to me. And I'll give you another classical example. COVID was impacting all of us, right? Not only in India, but globally also. We had probably one of the strictest lockdown in the world. Despite that, the way the country has bounced back is amazing. India is going to be probably one of the few countries which is, for the third year in a row, is going to grow at a GDP which is the highest in the world, right? And this is not my number. This is a number by IMF. So the resilience of the people, the demographics of the people, the will to fight back is so high. And I don't think it had anything to do with the government. The government could only jab you with the vaccination. But your ability to go back and start working and contributing to the economy, to your own well-being, was so strong. And that is what makes me confident. If I see the youth right now, I'm probably a lot more confident that their ability to take risk is so high. Somebody commented that we all job seekers. I would beg to differ with that, because if you go back, we are probably one of the second largest startup capital of the world. Yeah. So I see a lot of hope and future in what people at the younger generation are doing. At times I may disagree with what they're doing or the amplitude, but then that's the generation, it belongs to them. And I'm very confident that we'll do probably far better than what I've actually said.
And I believe, sir, that's more of a sentimental play when these events happen, but in long term, the fundamentals don't change. And that's what we have observed in COVID.
Absolutely, absolutely. So,
I have a question. What is the FPI's proportion in the total investment in the stock market? And do you anticipate this will increase in the coming time because the Indian economy is going up?
So the FPI investment, if I look at it as a percentage of their ownership in NSE 500, and I'm sure they invest all across, is about 17 to 18%. Okay, the domestic investment has increased from about 8% to about 12%, and that's the reason why, despite the 5% drawdown, they withdrew almost 5% of their total investment this time. Indian markets were really not impacted out there. You need to understand one thing, sir. Money always chases growth. So if there's any return to be made, the money is going to flow in out there. If we go by the IMF projection, India is going to continue to be the fastest growing economy in the world. That's where the money would be coming in. We'd seen significant outflows sometime from September till close to Feb. Okay, we saw close to about $7.5 billion being withdrawn. But in the last 2 months, we've seen more than that being covered up. There are $9 billion inflow which has happened in the two months time period. So on a year-to-date basis, we are actually turned significantly positive. So if you continue to show good growth, the money is definitely going to come through. There's no other country in the world which is offering you that kind of an investment opportunity in terms of depth, in terms of market capitalization. Yeah, we're going to have the 4th largest bank in the world, right? HDFC and HDFC Bank. Chintan spoke about the various numbers in terms of steel, etc. What he missed out was India's got the 2nd largest road network in the world now, already overtaking China. And we are not a very large country, right? So there are a lot of things which are actually happening, which is positive. And all these things are what is going to attract a lot of money into the country. If you have good governance, if you have the rules of the law, if you have the breadth of investment, and you have a startup environment, you will continue to see flows coming into the country. And if nothing else, they are very selfish. Return hai, paisa aayega.
One more question. What do you think was the reason for this withdrawal of $7.5 billion from the market for a short period?
So the way I look at it is, you had this US government raising the rates. Look, I think first of all, having interest rates at 0% was stupid, okay? It doesn't work that way, because the moment you have free money, then you have decisions which are taken, investment decisions which are not right. The moment you start raising the rate, this is what we call the fear, the flight of capital, or what we say that there's a uncertainty in the market. You would fear that India's foreign exchange or the rupee dollar would collapse and the investors would lose money. So there's a flight of safety of capital which actually happens. And that's what we had seen. This is not the first time that I've seen that. I've seen that so many times in the past, and every time they come back at a higher level in the market. Every time. You just need to remember, if there's growth, the money will flow back. There could be a timing difference out there.
About 99,000 crores have been flown from FPIs in year to date since January. So we've seen the data backing it up. Thank you so much. We'll take rest of the questions offline. Thank you so much, sir, for gracing us with your presence. Invite Mr. Subramaniam and Narayan to felicitate Mr. Chawla for gracing us with his presence. Yes, please. Yes. Yes, please come. Yes. Very well deserved.
Thank you.
Thank you.
Thank you, Mr. Chawla and Aditya, for this sagacious discussion. Moving forward, I would like to invite our next speaker, Mr. Manish Jain, Fund Manager, Ambit Asset Management, to speak on focused and diversified strategies. Mr. Manish Jain is the Fund Manager of Ambit Coffee Can and Ambit Tech's X portfolio. He has close to 2 decades of experience in research and investments. Before joining Ambit Management, he worked with global investment bank Nomura for over a decade as a vice president and lead analyst covering the entire consumer staples, retail, electrical durables, consumer discretionary, and economic space. Mr. Manish has over 15 years of experience in sell-side institutional equity research covering a wide range of sectors. He has worked with Lehman Brothers, NM Securities, ICICI Securities, and Motilal Oswal. He has been consistently voted as one of the best research analysts in the equity space by Asian Money, FIIs, and institutional clients, amongst others. Mr. Manish has cleared Level 2 Chart Finance Analyst and holds an MBA in Finance from Symbiosis Center for Management and Human Resource Development, Pune. Please, sir.
Thank you so much. It will be a very tough act to follow, Sanjay sir. You know, very few people know that when I started my career in Motilal Oswal, you know, we used to work together. Obviously, he was much more senior than me. I was much more junior than him. And here we are together on the same platform, talking to the same people, trying to educate people about the same things. Normally, all the fund managers that I've seen in my life as a sell-side analyst and also after being on the fund manager side, I think we are all alike, right? We are all optimistic by nature. We all always look at the brighter spot, and we are always telling people to spend as much time in the market as possible, which is what you know, Sanjay also kind of referred to. But today I'm going to talk about focused versus diversified portfolio. Now, if you move to the next slide, there is a very nice quote which you'll see here by Warren Buffett, which is basically diversification is protection against ignorance, right? Now, there are several myths, okay? Now, you guys judge what is myth and what is truth. Typically, what you'll hear, right, if you go to Investopedia, which is a basic level thing where you start learning investing, or any other literature that you'll see, what you'll realize everybody says is that diversification is less risky. Diversification reduces volatility, right? That's essentially what we've always heard. So if you want to have a slightly higher risk profile, have a very concentrated, very focused portfolio. But if you want to hedge your bets, typically what everybody will tell you is don't put all your eggs in the same basket, right? Try and diversify. Thoda sa oil and gas bhi le lo, thoda sa FMCG bhi le lo, thoda banks bhi rakho, but you know, de-risk your portfolio. But what I feel, where we all go wrong is the fact that it's not as much about being diversified or as much about being focused as it's being about focused on quality, right? If you invest in quality, if you invest in the proper stocks, and if you do your homework well, I think even concentrated or focused portfolios can do really well. Now, if you look over here, what I've tried to do, slight vested interest, you know, advertise Ambit and Coffee Can also, but it's a very concentrated portfolio, right? We started with 11 stocks. The churn has never in the last 6 years breached 15%. The average churn for the last 6 years is about 12%. It is as focused and as concentrated a portfolio as you'll get anywhere else in the whole world. Now, what we've tried to do over here is to compare our Ambit Coffee Can portfolio returns, right, with large cap MFs, and then Ambit Good and Clean portfolio with the mid cap MFs. Now, you see, starting 2017 to 2023, mid caps typically are riskier, large caps are typically supposed to be safer, MFs are more diversified, PMSs typically tend to be more focused. Which is less volatile and which is more volatile? What's the answer over here? You look at a focused fund like Coffee Can and look at the straight line, if you draw returns that it has, versus MFs. You look at the volatility. 1 year it is minus 3.1%, goes to 7%, goes to 15%, goes to 32%, falls back again to 5%. So diversified portfolios prove to be more volatile. And in bad times, Sanjay sir referred to ILFS crisis 2018. Look at MF returns in that year, in that chart over there. You realize that they proved to be more volatile. So focused strategy, if implemented properly, can actually work wonderfully well. If you move to the next slide, okay. Now I'll talk about again diversified versus focused portfolio. Again, another myth is that diversification typically will lead to outperformance. Diversified portfolios typically tend to work better in long term. Now these are MF. Okay, sorry, we've not changed the slide. Can we move to the next slide? Yeah. Now these are last 6 year returns for Coffee Can on a since inception basis versus Nifty 50 TRI and then large cap mutual funds. The names that we've kind of included over there are also mentioned below. Now you look at this slide, whether the focus strategy has been able to outperform the markets over a 6 year period, or has it been a diversified portfolio, which is typically your large cap MFs, who have been able to outperform the markets. Right? So again, another myth broken. We'll move to the last slide, okay? Because you guys have been very, very patient with us and you've been sitting here since the morning, very attentively listening. I'll not make it too long, I promise. The next slide is the last one, okay? And then we can start with the Q&A immediately. Okay. So there are 3 points that I want to make over here, which is basically diversified versus focused portfolio, or in general also, right? Sanjay sir also kind of referred to this thing, which is basically about timing the market versus trying to time the market. What will a diversified portfolio always try to do? He'll try to slightly have a higher churn. He'll try to get in and out of positions. Majburi hai, kuch kar nahi sakte, because sectors like oil and gas, sectors like, for example, utilities, capital goods, right? You'll have to have a higher churn. You'll need to time metals, mining. You'll need to time them perfectly well. If you hold a metal stock for 10 years time frame versus you keep getting in and out of positions accurately, believe me, you'll make more return by getting in and out of position. But the problem with that is that nobody that I know of, including one of the best fund managers in the mutual fund industry, stalwarts, Nobody has ever been able to time the market perfectly, ever in life. 2 times out of 10 that you'll go wrong, it's game over, it's zero-sum game. And that's why we always say that it's about trying to spend as much time in the market. Sanjay sir showed it very beautifully. I'm doing it more verbally. But the fact that it does not matter where the market is. If the goal is to go from 100 to 1000, it does not matter whether your journey is starting at 95 or 105. What matters is how smooth is the path. What matters is how good is the business that you are investing in. And that's why it's always about investing in a business, never in a stock. Second thing, which is majority of the wealth creators globally, okay? You look at Ramdev ji, you look at, Warren Buffett, even somebody like Rakesh Jhunjhunwala, a majority of their wealth was created by very few stocks. You can count the number of stocks on your fingers. At one point of time, I remember when Sanjay and I used to work with Ramdev ji together in Motilal Oswal, their entire wealth was invested in just one stock. One, Hero Honda. And that's what I used to do with him. Work on just one stock. Day in and day out. Hero Honda. Right? You look at the amount of wealth that Rakesh Jhunjhunwala has created in Titan. One stock. And measure the percentage of his wealth that has been created because of Titan. And you'll get the answer. Right? It's not about trading. It's not about getting in and out of positions. That's not what equities are meant for. Equity markets are meant for creating wealth and not generating income. Equity markets are meant for multiplying your money, and that's why you take the risk of equity, right? Otherwise, you might as well invest in debt. आज तो 7.5%, 10% double A rated paper में आपको debt में भी मिल जाएगा. Then what's the point of doing equity? Equity is about doubling your money every 4 years, and if you're not doing that, there's no point at all. The longer you stay, the more wealth you create for yourself, right? And that's the message I was trying to leave you guys with, which is basically de-risk yourself away from sectors that you do not understand, because equities fundamentally is like going back to school. You have to learn and you have to keep relearning every single day, right? If you ask people who have been in this industry for 30, 35, 40 years, they're discovering new things even right now. It's like an ocean. So stay away from sectors if you don't understand them. Don't try to get into metals, mining, utility if you're not able to understand them. There's always going to be a sectoral exposure risk. And don't try to time the market. The best example is look at the stock like Reliance. Okay, we don't have Reliance in our fund, obviously. So when 2020 came, between May, June, right up till October, November, we underperformed massively. Why? Because we did not have Reliance, and Reliance went from 800 to 2,100 bucks, and everybody came back. In 1 month, I remember we had an underperformance of about 6 percentage points to the index, which in a PMS business can kill you. People came back and said, you're not buying Reliance, you're not buying Reliance. I said, you look at the last 7 years return for Reliance. You look at what happened to Reliance from 2015 to 2020, and you look at what has happened to Reliance from 2021 to 2023. Look at the time frame of 10 years. What is the CAGR of return in Reliance that you've made? That'll give you an answer. So don't try to time the market. If you would have gotten into Reliance a little late at 1,400, 1,500 bucks, you'd still be sitting here and crying today saying that yaar kuch hua hi nahi, everybody else made so much money in Reliance, I did. So it's always better about investing in businesses and not stocks. That's the message I wanted to leave you guys with. Thank you so much for paying attention.
Thank you so much, Manish. Due to paucity of time, we'll just invite one question from the audience for Manish. Any question that we have? Please.
You made a point of differentiating between a business and a stock. Could you elaborate a little bit further on what separates the two?
Yeah. So suppose I give you $1 billion today to buy a company and run it like your own. What are the factors that you look at? How's the management? Can you work with them? Are they good people? Does the philosophy gel with you? How's the promoter family's corporate governance track record, not just in this company, but otherwise also? What have they done in their private ventures, other places, right? You'll not be bothered about stock returns, would you? You'll more be bothered about the profit that the business generates and how to increase the profitability, EBITDA margin kaise badhaun, profit margin kaise badhaun, working capital kaise kam karun, right? Your due diligence is going to be much higher, it's going to be much deeper. Your time frame for the investment is going to be much larger. You buy 100 rupees of stock, you're ready to lose and get out of that position anytime. But you invest in business, it's a lifelong commitment, right? It's a journey of evolution together. And that's the point I was trying to make, where have a mindset where you're investing in a business and not a stock. Stock investments are always fraught with risk because you're focusing on profits. That's an eventual outcome. That's return is the eventual outcome. It's not the target. Thank you guys. Thank you guys for being a lovely audience.
Thank you so much, Manish. I would just invite Mr. Kiran Moge to please felicitate Manish for his audience.
Thank you, sir. Now, our next speaker is Ms. Anju Chhajar, Senior Fund Manager, Nippon India Mutual Fund, to share her thoughts on fixed income outlook. She is a chartered accountant and had graduated in commerce from Shibnath Shastri College, Kolkata. She has over 16 years of experience in financial services. She joined Nippon Life India Asset Management Limited Company as a fund manager in 2007. Her earlier stint was from 1997 to 2007 with National Insurance Corporation Limited, where she used to manage the debt investment portfolio of the company. Please put your hands together for Ms. Anju Chhajar.
Good evening, everyone, and big congratulations to the team, the Wealthy Nivesh team for completion for the AUM of 150 crores. I know after equity debt is not very interesting, but I'll try to talk about it in a little more, try to make it more interesting. I've been given a topic of talking about the outlook of the debt market. Before that, I would like to highlight, I just ask one question to the audience. What percentage of your portfolio is equity? That I would want to just with a more than 50% and less than 50%. Can we have a raise of hands? More than 50%? So I saw 7, 8 hands here. So I believe this means my understanding without my interaction with people who are around, majority of the people, there will be higher allocation to debt. The higher allocation to debt could be to the conventional debt products, which is fixed deposit, post office savings, and other senior citizen schemes, or whatever schemes is applicable. And or PF, Provident Fund, which is, if you are a salaried employee, then a good percentage goes to PF. So a higher percentage always of our investment goes to debt, and a lesser amount goes to equity, which should change. I personally think equity allocation, at least at the beginning of your career, should be higher than the debt. But debt is a good percentage of our portfolio, and it is we are more invested in the conventional products. I will try to bring it out a case where debt should be higher as a product, and we should move to mutual fund and less to the conventional debt products. I'll try to make a case out of that. Before I make that case out of that, I'll try to just present the presentation which we had worked on, more to tell you how interest rates in India or worldwide are dependent on few things, few macro things, which is one of them is inflation. Inflation is the most important factor based on which central banks raise or reduce the inflation and growth. So they try to balance inflation and growth. In India, India has always been a high inflation economy, the economy where inflation was always high. So hence interest rates were very high. But if you look at pre-pandemic, we went to a 2015 to 20, we went to a scenario where Reserve Bank was given a mandate of controlling inflation and bringing inflation in the range of 4 to 6. And that happened. And once that happened, right now, RBI, Reserve Bank of India, targets inflation to be within the range of 4 to 6%. We have moved out of the, I remember as a child, when I was growing up, even our NSC used to give us returns of 18%. Sorry, 12%, 13%. And your other assets used to give 17, 18%. But even an NSC, a government security, and government investment in risk-free returns used to be around 12%. Government securities were in the range of 11 and 12%. But now we are in an environment where interest rates will remain in the current range of 6 to 7% or 6 to 8%, one would say. On the higher side, if we are seeing inflation going up, that would be about to happen. How is the inflation playing out? What is the current inflation environment? Current inflation environment is such that India is in a very good scenario. From if we were the only country to look at, our macros was the only thing which Reserve Bank would have been looking at, then we may have started cutting rates earlier than later. But we are not only the country, we are in an environment, we are an open economy, we have to look at international environment. That's why we are where we are right now. The Reserve Bank of India has forecasted that for FY24, we will close inflation at around 5.3%. Why? And that is a big positive environment. Similarly, growth, we are in a good scenario. Though internationally, if we see, things are very different. India will have a growth at around 6%. Post-pandemic, we saw a very good growth. Now the growth would be, but 6 is not the target. Reserve Bank would want to target higher growth rates, and hence the general expectation in market is that we will see, gradually we will see, our Reserve Bank of India would want to cut rates, but the rate hike cycle could be very shallow, of 25 to 50 basis point over in 2024 sometime, depending on how US markets pan out. Please. Another positive part of it is fiscal deficit. Fiscal deficit, the combined fiscal deficit of state and center has come down to 7%, has come down to 8.6% for the FY24 and is expected to come down further. And what is more important is the quality of fiscal deficit has come down, has improved quite a bit. Why? Because the revenue collections have improved, GST collections have improved. GST has brought in a much larger revenue. So fiscal deficit has improved broadly. So this 8.6% fiscal deficit may look a high number, but the kind of capital expenditure which governments are doing, that will bring in more and more growth, and hence what we say is the quality of the fiscal deficit is much better. CAD also is under control. Next slide. Another more important thing from interest rates point of view is the liquidity scenario in the system, which most of us don't understand outside the market. But from the banking industry perspective, liquidity is a very important factor. For various reasons, liquidity comes and goes down. Currently, liquidity is in a more of a balanced scenario. Reserve Bank of India, the 2,000 rupees note, which has come, removal of this, has improved liquidity by around 1 lakh crore in this last one and a half month itself. We were at 2 lakh crore core liquidity in March end, which has increased to around 3 lakh crore right now, in spite of liquidity going out due to CRR movement and due to LTRO changes. So broadly, liquidity is, and RBI has assured the markets that liquidity will remain good, and they will provide the kind of liquidity that needs to be provided. Adequate liquidity will be provided. So in all this environment, what are we looking at? We are looking at a shallow rate cut cycle in 2024. If you ask me, 1 month back, we were saying it could happen in 2023 itself, December 23. But again, due to US US decisions that they may hike, give to another 50 basis Fed hike may come in, has pushed this thing to 2024. So that's a broad idea. So now all this thing, I understand as a lay investor, as a individual investor, we don't understand or don't want to get into the intricacies. Actually, we don't need to get into the intricacies. Debt products, please change the slide. Please change the slide. Next. Next. Yeah. Debt products. Each of the debt products which are different types. These are more broadly the type of debt products that mutual funds can launch. So we have various, sorry, can I have a mic? So each of these debt products, if you look at, they have a time horizon. You know, in any kind of interest rate environment, whatever may be the interest rate environment, whether it's going down, going up, each of these products, if we choose, depending on our investment horizon, they are the right, that is the right time to invest when you have the money. That is the beauty of these products. Liquid fund, overnight fund, naturally, these are one-day investments, very short-term period. You can invest at any point of time. More of parking of money which would be lying in your savings bank account would be earning 3% broadly. So that is the fund which one should look at, liquid fund. Then we have three ultra short-term products, money market, ultra low duration. In any kind of interest rate environment, if you are investing for a 3 months to 9 month time horizon, if you have money lying in your bank account, which you think you may need in a very short period, your emergency fund or any kind of money which you think you want to deploy later, any of these three products can be chosen from for investment purposes at any interest rate scenario. You don't need to know what is the interest rate scenario or how the interest rates will go up. Or if you are invested in these products 3 to 6 month period, at any point of time, one, these products provide you liquidity at any time. Like fixed deposit, if you book for a 6 month period, the liquidity comes after 6 months. But for these products, liquidity is an overnight liquidity available. So at any point of time, these are products which can be used for STP purposes. For just for STP purposes, you can just use them, or you can use for parking your short-term surpluses. Then, if you have money which we deploy generally in fixed deposits for 1 to 3 year period, all these intermediate products, these are intermediate duration products which run a duration of 1 year to 3 year. Most of these products in the market would run a duration of 1 to 3 year product. And if you are investing for 1 to 3 year period, you can invest in any interest rate scenario. And I'll give you some statistics in my next slide, which shows that in any kind of interest rate, these products beat your FD returns. Why do they do? I will come to this later. Why do they beat? Because the duration is 1 to 3 years, so the interest rate risk is that. So if you remain invested for 2 years, all your interest rate risk is diluted. Most of the returns that come from carry. So hence, if you match your investment horizon to the right product of the debt market, these products you can invest in at any point of time, and what additional benefit that these products offer. I know in March 23, what happened was taxation was removed. The 3-year taxation benefit, indexation benefit has gone. So everyone says, because indexation benefit has gone, this is not no more debt product is better, it's better to be in FDs. Everyone would say that, but it's not true. Why I'll still make a case for a debt product? The case for being in a debt product is your taxation, incidence of taxation arrives only when you redeem. Normally, if I roll over my FDs, I don't mature them most of the time. If you go and see your portfolios of fixed deposit, 8 out of 10 times you would have rolled over. And if you need, then you go and get a premature FD. But otherwise, we roll over the FDs. If I'm rolling over the FD, I'm paying quarterly interest, quarterly taxation every quarter. Whatever may be the case, I have to pay quarterly taxation. TDS is being deducted. And annual taxation anyways when we are filing our returns. So, but these products, any of these products you are invested in, you can remain invested for 10 years if you don't need the money. And your tax incidence arises only when you redeem. That's a big benefit. De facto, it may so happen that you have not redeemed for years only. And that's the benefit of these products. So that's the case for debt mutual fund. Why one should invest in a debt mutual fund than in a fixed deposit. Taxation is a very important thing. It was a big benefit which we used to get. But please remember, Nirmala madam has made one statement very clear. Currently we are taxed on equity also 10%. Taxation will go from all investment revenue. That is the roadmap which government has given. Insurance it has gone out of. Debt market it has gone out of. It will go out. I don't know how long it will stay in equity and in what fashion it will stay if it stays. I'm not saying it will go off, it may stay, but how long and how, because PF also they have bought it under taxation if it's a larger amount. So I don't know about equity. So broadly, similarly, these are products, income, yield, dynamic, strategic. These are long duration products. Here interest rate risk is higher, so hence the time horizon should be higher. So I would generally say I've written here beyond 2 years, but one should have a higher time horizon of 3 years or 5 years to remain invested. So this could be an debt allocation, core debt allocation, but these products are very good products to replace any FD of 18 months to 2-year FD, because most of the FDs are done for that maturity profile. Other than that, credit risk fund, where the credit is higher, so the carry of those products is higher. So hence, they give you, the duration is similar to a short-term fund, but they give you a higher carry and may give you some additional returns over these funds, depending on the credit profile of that fund. Beyond that, we used to have fixed maturity plans, which were the favorites of the market, but today they are out of flavor for various reasons. We have target maturity ETFs and index funds. Again, I will still say these products now with taxation benefit going and all, open-ended intermediate duration, short duration products are a better investment avenue than these products, because here also there is a terminal maturity. You have to redeem on a particular day. So it's best to be in an open-ended fund where you can continuously remain invested. That's the broad idea. Please next. Yeah, here so as I have highlighted, there are 2 types of risk which any debt fund has. We are market related for returns. We cannot assure you any performance that I'll give you 8% return or a 7% return. We don't have the ability to do that. If someone is doing it for you, it is just an indicative thing based on the gross yield and the interest rate scenario and his assessment of interest rate scenario. We cannot promise returns. Yes, we can tell you my current gross yield of my portfolio is this. Current interest rate scenario tells me this. This is the duration of that portfolio. Hence, we think this product can give you anything between 7.5 to 8.5, 7.5 to 8, 7 to 8, depending on the gross yield and other assessments of the interest rate scenario. Now, we did one exercise internally to see whether we can outperform a fixed deposit or not. Now, we took 3 types of products: conservative, intermediate, and aggressive. So, conservative is basically that low duration category which we were talking about, where their 6-month performance we assessed out of 134 plus 33. 134 times out of 167 odd, 167 odd times, 1.86% higher return than any FD at that point of time. 6 months back, when we did this exercise in March actually, 6 months back, if I would have booked an FD, these funds would have given 1.86% higher return. This is not my fund only, this is across industry. 1.87 is around 2% higher returns we are able to deliver over a 6-month period, which is not a small amount. And that, and 33 times we have underperformed. And this is not a small period, 2010 to 2023. This is run on a data of 2010 to 2023. Yes, because we are market related, there will be underperformance, but that is much lesser than the, if you see at this thing. So similarly, for intermediate duration, which is basically the short-term funds, we run this exercise 107 times in the number of months, because each month we rolling returns we are taken. 107 months we saw 1.66% average higher returns. So what this table is telling you, that fixed deposit is a good product, a sure return product. I have no questions about it. It is the simplest product, which is the logo of them, simplicity. Yes, but simplicity is there in FD. It's very simple to understand, and we have grown up on FDs. But if you are looking at equity as a product, debt, mutual funds are a great investments if one looks at it over a longer period of time. Here also, you have to, you may have one bad experience because of your first timing of investment. But if you are regularly investing, instead of doing a recurring FD, invest in a low duration fund. Make a recurring deposit with low duration fund, or a short duration fund. So it's another product I will just mention in this, as part of my last this thing. We have a Nivesh Lakshya fund. This is only for us. Nippon India Mutual Fund has one product called Nivesh Lakshya fund. We position it as a replacement or a parallel to a PF. The Nivesh Lakshya funds invest in 2040 to 45 GSEC, which is 20 year around. 20 year from today, around 20 year assets, GSEC, common securities, zero credit risk. It's a very good product. Current carry of that product will be around 730, 740. Depending on the interest rate environment, whatever the rate is, the carry moves accordingly. It is a very good product. If we have done one analysis on that product also, because it's a government securities, there's a semi-annual coupon that comes. It is not the timing of investment that is important in that product, because most of 70% of the cash flows are half-yearly investment. So actually an auto SIP is happening. So the whole cash flow which you get at the end of the period, it is after every 6 months you get some cash flow. So it's not the date of investment which is important, it is the average period. So if you want to invest other than your EPF money somewhere, that's a very good product one can look at. That's the only product which is a little different from the industry, and not many in the industry have a similar product. Thank you. Yeah.
So ma'am, this is for the benefit of our audience. You know, in India, we still have this problem of people parking their money for fixed income into fixed deposits only. Now, I would like to enlighten you, I would like you to enlighten us, how do interest rate movements affect FD and mutual funds from fixed income? Is there a lag in the time frame in which interest rates get reflected in FD and in mutual funds?
Mutual fund, it is immediate. Any interest rate movement, we are actually forward-looking. See, markets are always forward-looking. If interest rates are going to drop 6 months down the line, if RBI is going to cut rates 6 months down the line, mutual fund markets will price in those assets in advance. So we will be forward-looking in that sense. FDs, banks also are forward-looking. They also know what is happening in the market. But to some extent, they are lag. There is always a lag. What is it? FD, if you have locked your money at 7.5%, the rate does not change till you get the money back. So that is fixed rate investment. Mutual funds are like floating rate to that extent. But if you are invested, you get capital gains the minute rates come down. And if rates go up, you will have some capital losses. Because mutual fund at the end of the day, debt products all, please understand, none of the debt products are move in a linear method. This is not a linear, FD is linear returns. Debt mutual fund may not be like this, like equity, but it would be like this. It will have its volatility. But it will start here. If our duration of my product is 2 years, over a 2-year period, I will be here only. So linear with this linearity. But FDs will remain linear. So that's the difference between an FD is a linear returns. Here you will have this type of return, but if you have invested with a time horizon of 2 years, when rates were around 7%, the product at the end of the 2 year would give you 7% or a little more only because of various other scenarios. But FD, it will give you 7% over a period. So that's the difference. Yes, you don't want to run that little bit of volatility which that's the cost of it. Because why? We are able to give you liquidity. You can move, if interest rates moves up and down, I may move from low duration to a short-term fund. Because if interest rates are moved up, this product may give me better returns. Sir will give you an advice कि low duration से अभी निकाल लो, अभी अपने को short-term fund will give better returns. So sir will advise you and you can move to that and get better benefit. Though low duration for the short period you would have remained may have given you suboptimal returns.
Well, ma'am, yeah, very well said. So my next question you almost touched upon at the fag end of your answer. Ma'am, taking in view that we are having a very flattish interest rate, curve right now, where do you think the sweet spot lies?
So flat curve means without interest rate risk, you are earning the same return. That is what the flat curve means. Even if I am investing for a 6-month low duration fund also, I am getting the same carry. A short-term fund, short duration fund which has a 2-year, 3-year interest rate risk, that also is giving me a same carry. And 10-year GSEC, 10-year curve also is giving me. The difference between a 1-year and a 1-year CD and a 10-year GSEC is 15 basis point. That is basically to tell you 1-year CD is around at 740 and 10-year GSEC is, corporate bond is around 755. So 15 basis point spread is there today. So which tells you it's flat. So where one should be. We do not recommend anything but depending on your time horizon of investment. Nothing is sweet spot. If my time horizon of investment is 6 months, I will invest in low duration. That's the beginning of my presentation when I started about talking about products. In any interest rate environment, you can invest in any product depending on your investment horizon. If you want to invest in a gilt fund for 3-month period, then you are taking a trading call, you are taking an interest rate call. That is a different thing. From an investment point of view, if you are investing for a 2-year period, it will not be right for you to invest in an ultra short-term fund. Please invest in a short-term fund. It's as simple as that.
Great. So answer lies it's more internal than external.
Yeah.
Great. Ma'am, making a comparison, so during our speech, the lectures that we had today, it was pointed out that we now have a delinking with FII money up to a very large extent, whatever be the reason, whether it is SIP money or whatever. Do you foresee, and of course reasons can't be same, do you foresee any delinking of money rates in India and US?
Delinking to some extent has happened in the recent 1 or 2 months, but it cannot be delinked totally. Because at the end of the day, RBI cannot act unilaterally. You have to see flows. There is a currency that has to be managed very much. So we cannot be a unilateral here. We may be 3 months ahead or 3 months behind. From interest rate, what RBI takes a call relative to Fed. RBI may come and cut rates post Fed cuts or may cut rate before Fed does, depending on our interest. But we cannot be totally delinked in that sense, because at the end of the day, currency has to be managed, and currency is depending on US rates, international, each economy, each reserve, all the banks, reserve banks of all the world economy, what they are doing has to be taken into account. and our economy also, our inflation, crude price. It's not an India affair, it's an international affair. So commodity prices, all in international markets. So we cannot be totally de-linked. Yes, there can be lag and lead and lag thing.
Thank you, ma'am. Now we open to audience for any question from their side. So that comes to the end of session of Anju ma'am. Thank you, ma'am. Thanks a lot
Thank you very much.
for sparing time on a Sunday. I'll now invite Mr. Deepak Sangvi, one of our leading clients, to confer a small token of thanks to ma'am for her presence in the celebration. Thank you.
Thank you.
Thank you, ma'am and Ankit, for wonderful discussion. Now, I would like to invite Mr. Vaibhav Shah, Associate Director, Head, Business Development Strategy and International Sales at Mirai Asset Mutual Fund, to share his thoughts on market versus investor returns. Mr. Vaibhav Shah has over 17 years' experience in this field of financial services and stock markets. Prior to this assignment, Mr. Shah was Head Product Marketing and Corporate Communications and was handling product development function of the AMC since August 2011. Prior to joining the AMC, he has manager mutual funds and alternate investment products at DBS Bank Limited. Mr. Shah has also worked as product manager Indian equities with ICICI Bank Limited and associated with organizations like Karvi Stock Broking Limited and India Bull Securities. Please put your hands together for Mr. Shah.
So I'm taking the liberty, as a wealth manager, one of the most dreaded questions that we all encounter, market में return आते हैं, हमारे नहीं आते. So Vaibhav will answer that question. If you have this doubt कि market में return आते हैं, हमारे क्यों नहीं आते, just look forward to this presentation. Thank you, Vaibhav.
Thank you, Ankit, and thanks the entire team at Wealth Nivesh to give us this opportunity. One very important thing, I'm sure all of you have been here since afternoon, so it's been a long day. So last 15 minutes, and we'll try and make it as interactive as possible. So maybe when you see this photo, what do you think? Is he happy, sad, confused? Maybe can some people raise hands? Happy? No one thinks. Sad? Confused? Everyone thinks he's confused. And that's what happens with markets. When you invest in markets, you think your neighbor is making money, he's buying a Mercedes, he's buying a BMW. But when you see yourself, you see you're not making returns in markets. And this brings me to the topic for today, which is how funds always deliver returns, but somehow we don't make money. And I had a lot of experts before me who speak fund management language, they understand markets. As investors, our main job should be how do we make returns? Because markets are not in our control. The only thing in our control is how to make money. So let me see if I can change slide. Yeah. So this is a slide which is actually a reality for many of us, where funds have given exceptionally high returns, but our returns are maybe half of what the funds return are. And this happens mainly because somewhere it has got to do with how we behave in markets and how we invest in markets. So today we are touching on the topic of how investors' behavior is the most important thing that you can control while making investments.
Have all of you seen this chart? And do you all remember 2008, 2007, 2008? Right? And you would have seen there was a lot of euphoria in markets and we used to pump in a lot of money. And suddenly 2008, 2009 happened. And you really lost 50% of your wealth. So markets goes through this cycle where you become very greedy or you become very fearful in a very short period of time. One of the beautiful things that Warren Buffett says, and Warren Buffett is considered the father of investing, is that when a panwala starts talking about stock markets, then please redeem all your investments. And when you go to cocktail parties and everyone says, what is your favorite stock? That's a danger signal. And when you go to markets and events and no one talks about stocks, actually that's the time you should invest in stock markets. So maybe you let me know whether today people are talking too much about stocks or no. Do you think? Where do you think we are in this journey? Which stage are we? Do you think we are in euphoria? I don't think so. I don't think so we are in euphoria. In euphoria, everyone is like, yaar, maine to aaj itna paisa kamaya. I'll tell you my honest story. When I was in stock market, like my introduction said, in 2017, I was thinking every day I was earning what I used to earn in a month. And I started thinking, why am I working? And then 2008 happened and then I said, thank God I have a job. So I don't think so we are in that stage that euphoria is still there. I think we are still in a stage where I don't think so people are disappointed. That's a time maybe a year and a half, 2 years. But we are somewhere here. We are still excited. We are hopeful Mr. Modi wins. Let's see whether he wins or no. But I think there's still a lot of rally left in markets. And I believe a lot of money is still to be made in markets. If you think behavior impacts us, I think so you will be wrong. Behavior actually impacts the world's most smartest people. Does everyone know Isaac Newton? What did he invent? So this is a story of Isaac Newton. And this story says, Isaac Newton invested in this company. When you can see it's almost at the bottom. He exits, he makes good amount of money and he is very, very happy. Then he sees his friends becoming even richer than him. And this is a time he starts becoming very jealous. He starts seeing his neighbors and says, oh, they are making more money than me. I bought this stock very early. What should I do? Now Isaac Newton again buys the stock. And this time he invests more money in this company. Because he's made money in this stock, he feels he should invest more money. You know what happens? And Isaac Newton becomes broke, becomes bankrupt. It's an actual story. And this is what markets are all about. It's all about discipline of investing. This happens to the brilliantest minds of the world. If you don't follow discipline of investing, you will not make money. And why does this happen? I think a lot of you have been investing from 2008. Maybe if I can have few people to raise hands, if any of these stocks are part of your portfolio. Maybe any Anil Ambani stocks, Unitech, Suzlon, JP Associates, anything that any one of you hold for more than 10 years? JP Associates. Suzlon, maybe you are good. Very few of you have ever experienced that. Whenever I have gone to conferences, I have seen most of the people raise hands for most of these stocks. And this is the pleasure when you make gains is this much. But the pain for the same quantum is this much. And that's why you hold stocks for a long period. आप assume करते हो उसकी price आएगी. उसकी price आएगी. India में, you know how many stocks are listed? 8,000 stocks, yes. How many are traded? maybe only couple of thousand. I used to look at my father's demat statement holding many years back. उसमें से 25 stocks were completely not even trading or they have been delisted. Zero price. How many have the same experience? Zero price for many stocks. क्यों हमने बेचे नहीं है सर? होप कि उसका कभी ना कभी प्राइस आएगा. तो that's the pain of holding. And the first rule of investing is hold on to winners. If you held Reliance Industries or a Sun Pharma or an Hindustan Lever for this same time frame, then you would all have become, you're all millionaires, I know, you would have become all super millionaires. You know Narayan Murthy, all of us know Narayan Murthy, right? You know what is the worth of Narayan Murthy's driver? How much is he worth? Can you imagine? Narayan Murthy's driver must be worth 100 crores. Okay. This is because there was stock given to him and he didn't understand stock markets like all of us do, or at least we think we do. And he held on to that stock for very, very, very long period of time. And because he held this stock for a very, very, very long time, he made a lot of money. So when you have winners, please hold to winners. When you have losers, sell them first and sell them quickly. So a lot of the speakers said, and which is very important, is buy companies where corporate governance, management quality is good. Buy companies as if you are the owner of the company. Don't buy के अरे कल क्या भाव है, परसों क्या भाव है, उसका भाव एक महीने के बाद क्या होगा. You don't know what will happen. Buy as if you are the owner of the business and you will make a lot of money. Next, all of you have heard the story Pied Piper? What happens in Pied Piper? Bed chal. So everyone follows. Herd mentality बोलते हैं English में. So same thing. Why are you investing in markets? My friend is investing. My neighbor is investing. Don't invest because your friend or your neighbor or anyone else is investing. Invest because you want to invest. Invest because you have surplus money. So when you make an investment in a particular stock or a mutual fund, don't do it because your neighbor, friend or anyone has invested. Invest with your own research, with the help of research from Wealthy Nivesh and the team to make your decision. Invest with your clear objective and don't follow everyone. How many of you watch CNBC? Please raise your hands. CNBC. Very few. I'm surprised. Or others are scared. But honestly, if you want to make money in stock markets, stop watching CNBC. I'm not against CNBC. Okay, people who come on CNBC, please hear them out. And some of the experts were here today or future or wherever they come. They'll say, buy today. You go to the same guy tomorrow and he'll say, sell tomorrow. After 1 week, you'll ask him, what is your view? His view is negative. After 1 week, his view becomes positive. I don't know how it changes so fast. So the idea is, cut out the noise. When you make investments, don't listen to people, or even including me, who claim to be experts. Do your own research. And first, CNBC mein I can tell you, no one is an expert, no one gives free advice. Sir will also tell you there is no such thing as free lunch. Free advice kuch nahi hoti hai markets mein. So all experts who come on CNBC have a vested interest. Take multiple opinions before investing in markets. Don't rely on only one news. Right? And don't talk to, as like I said, social parties, kitty parties, don't talk markets. You will lose money. Don't talk to your neighbors, relatives, and buy those stocks. You will lose money. This is a beautiful circle. When we invest in markets, एक circle होता है which says what you should consider while choosing a stock. But हम क्या सोच के लेते हैं? In small blue circle. So we choose to invest in market only investing basis few things that we actually want. So there is an information that you should use while investing in markets, and there is an information that you believe you want to hear while investing in markets. And this is called availability bias in investing. So while investing, be very smart, take care of all information while investing. एक बहुत important चीज़ that I want to say is, in investing, while you invest, this fund has done exceptionally well for past 5 years. Last 1 year return is bad. What do you do? What do you think you should do? Should you buy? Should you hold? Should you sell? So I'm assuming if the process remains the same, there is no reason for you to take a decision other than that. A very brilliant example Manish had given, that there were times Reliance didn't do very well for maybe 3 years, 5 years. If you believe it's a great company, doesn't matter if it doesn't do well for 2-3 years. Actually hold it on for long period. Idea is, you are the captain of your own ship, you're captain of your portfolio. When you invest, don't look at last 6 months, 12 months return. Look how things have generated returns for long periods. And when you start seeing returns over long periods of time, then you will make a lot of money. So this brings me to the second part of the presentation, is what should you do? So this pie chart tells you in left side things that matter, and the right side things that you can control. आप बताओ, can Modi win is in your control? Maybe your vote you can, but maybe not. What will be the government policies? Can you control? I don't think so. Can you finalize whether US में recession होगा या नहीं होगा? Can you decide what will be the income tax after 2 years? So these are things which are completely out of your control. So don't spend time and energy on this. Just spend time and energy thinking. A lot of people asked, foreign flows आएंगे कि नहीं आएंगे? क्या फर्क पड़ता है? आपके flows आएंगे कि नहीं जब market गिर रहा है? That should matter. So the thing that we need to think and ponder is कि market जब गिरेगा, will I invest or will I not invest? So focus only on things that you can control. And if you can focus on that, you can make a lot of money. Mr. Anju Chabra in the previous session showed how in debt you should make investment. But मैं आपको एक चीज़ बोलता हूँ, हम invest जब करते हैं, while you say there are some children I can see today, when you say invest for children and say I want to invest for their marriage or for their education, would you want to redeem that money till their education date or their marriage date comes? Ideally you will not. So you will hold on to that investment because you said I want this money only for their marriage. For each investment, why don't you put a certain goal for your investments? Because when you put a goal for your investments, आप एक return chaser के बदले एक goal chaser हो जाओगे. And it doesn't matter whether index 65,000 है, 56,000 है, या 1 lakh है, या 35,000 है. What will only matter is कि आप goal से कितने दूर हो. So for example, your goal is that you want to plan for your children's marriage, which say cost maybe 3 crores. And today markets are at 65,000. और आपका portfolio खाली 25 lakhs है. How does it matter कि कल 70,000 होगा या 1 lakh होगा? आपका गोल तो 3 करोड़ है, आप तो 25,000 पे ही हो. So it will not matter if index is 70,000, 80,000 or 1 lakh. If the goal will happen after 15 years, stay invested. Because if you stay invested for 15 years, you will make maybe not 3 crores, maybe you will make more than 3 crores. And might be that you might make a grander wedding than what you thought. So idea is make a goal, invest as per that goal. That's the main thing that you should think while investing, rather than invest based on the past returns of markets. One very important thing, and I'm sure Ankit and the team will tell you, is that market में ना return बनते हैं, हम सोचते हैं timing से बनते हैं, तो let me time markets. But history has proven it. Returns only come by making the right asset allocation. Right asset allocation मतलब इक्विटी में कितना इन्वेस्ट किया, कितना गोल्ड में, कितना रियल एस्टेट में और कितना डेट में. हाउ मनी, whenever I go to any forum, people said रियल एस्टेट में मेरा एक्सपीरियंस बहुत अच्छा है, स्टॉक मार्केट्स में खराब है. तो आई हैव अ क्वेश्चन, रियल एस्टेट का आपने इन्वेस्टमेंट किया, लैंड हो या कोई भी प्रॉपर्टी, आपने कब बेची? मे बी 15 years, 20 years. अगर if you had given that 20 years to stock markets, I could have bet that stock markets would have outperformed real estate. But आपने equity every year, 6 months, 1 year, 2 year के return देखे, and you redeemed from that. That's why your experience in equities is not that great. अगर आपने real estate की तरह equities में invest किया होता था, तो सेंसेक्स चालू हुआ था 1980, तब इंडेक्स लेवल था 100. इंडेक्स लेवल आज है 65,000. इंडिया में आप कितनी भी रियल एस्टेट देख लो, कोई भी मार्केट देख लो, 100 का तो 65,000 कोई भी मार्केट में नहीं हुआ. और ये तो मैं मार्केट की बात कर रहा हूँ. आप स्टॉक्स की बात करोगे, दे विल बी मैनी स्टॉक्स जो 100 के 65,000 नहीं होंगे, 100 के 6,50,000 होंगे. Like I said, Narayan Murthy's driver is worth, say, maybe 100 crores. So give stock markets the same time frame of 10 years, 20 years. Do the right asset allocation. Market timing mat kijiye. You will make lot of returns. एक और चीज, when markets go up, book some profits. When markets go down, add money in markets. This is called portfolio rebalancing. In this chart it shows, अगर आपने portfolios को regularly rebalance किया, you will tend to make 30 to 40% more returns by doing portfolio rebalancing. And the team here at Wealthy Nivesh will tell you when to change your allocation between equity, debt and how frequently to rebalance. पर अगर आपने रीबैलेंस नहीं किया और जब मार्केट गिरा और पैसा नहीं डाला और जब मार्केट्स ऊपर चला गया और प्रॉफिट बुक नहीं किया, तो यू विल नॉट मेक दैट मच. यू हैव टू मेक योर एसेट एलोकेशन एंड रीबैलेंसिंग बेस्ड ऑन योर गोल्स. मे बी द लास्ट कपल ऑफ स्लाइड. अगर आपने देखा, लास्ट बहुत सारे एक्सपर्ट्स ने बताया बिफोर मी कि स्टॉक मार्केट्स के रिटर्न 15% है. अगर आप ये चार्ट देखेंगे और इसकी एवरेज रिटर्न देखेंगे, देयर इज नॉट अ पॉइंटर, अदरवाइज आई वुड हैव शोड इट. बीच के अगर आप पॉइंट देखें, 14.9, 15, 14.4, 14.7, दिस इज एवरेज रिटर्न ऑफ मार्केट ओवर 7 year, 10 year, 15 year, 25 years. मार्केट्स के एवरेज रिटर्न फ्रॉम 7 years to 25 years 15% रहे. इफ यू गेट द टाइमिंग राइट, तो आपको 30%, 20% बन सकते हैं. इफ यू गेट योर टाइमिंग रॉन्ग, then also you can make higher returns than FD. But if you invest on an average for 7 years, 10 years, 15 years, you will make on an average more than 15%. और आज इंडिया में कोई इन्वेस्टमेंट नहीं है जो आपको 15% टैक्स एफिशिएंट रिटर्न्स दे सकती है. सेंसेक्स हैज़ बीन देयर फॉर लास्ट 40 years. 40 years में एक साल में 250 ट्रेडिंग सेशंस पकड़ लो तो 10,000 days है. इन these 10,000 days, if you missed any 10 days, okay, any 10 days in 40 years, your returns from 15, okay, if you had invested for all days, you would have made 15%. If you missed 10 days out of that 10,000 days, 15's return would have become 11. If you missed 20 days, 8%. And if you missed 40 days, 3%. Which are those 10 days, 20 days? Can any one of us tell in advance? Can any one of you predict that 10, 20 days in advance in the next 10, 20, 30 years? Then why are we trying to time markets? Stay invested. If you don't know in the next 5, 10, 20 years, which are those 10, 20 days, there's no point timing markets. Stay invested. And if you remain invested, you'll make enough wealth. This is story of an actual mutual fund in India. This fund, if you had invested, NAV of 10 has become how much? More than 1,000. 10 has become more than 1,000. इसको बोलते हैं more than 100x returns. 100 times return. In this, you will see there are many years, 3.5 years, 0 return. There is a year when 50% of that fund return is lost. 6 years, 0 return. Yet, this fund has generated 100 times return. So stay invested. Beautiful saying by Warren Buffett. Invest assuming markets are closed for 10 years. And if you invest for long, you will make a lot of money. So last slide saying what we believe you should do. One is I'm very happy to see a lot of ladies here. Finance is not a man's job, right? Both of them have to be equally involved. Next is start maintaining a budget and decide how much you will invest. Third, please all of you get enough insurance. Pandemic has told us less insurance means less safety for your families. And most important, I was behind this chair, it says take help of an advisor. If you are sick, you may do home remedies. If you get more sick, what do? Who do you go to? Do you go to a carpenter, plumber? No, you'll go to a doctor. Why? He is the solution for you. So when you invest in markets, why go to a cocktail party and listen to someone and buy that stock? Why go to a presentation and hear someone and invest? Invest listening to your advisor, because he knows how much you need the money, where you need the money, and how long you need to invest. So take the help of an advisor. All our funds are doing very well. So unlike all the other speakers, I have not a single slide to show why Mire has done well. I'm sure this pitch Ankit can maybe tell you. If you choose any category, I can tell you we have the solution for you. But last, we see this line which we call as volatility. अगर हमको heart attack आता है, if it doesn't go up and down, you know what does it mean, right? And if markets don't go up and down, that can't happen. So markets will keep going up and down. That is their job. What you can do is to manage your behavior. Because if you manage the way you invest, I can tell you a lot of you will make a lot of money. So best of luck, happy investing, and try and make a lot of wealth. Thank you.
Well, I should really appreciate, I have never seen any speaker who comes last being so energetic and so engaged. If you agree with me, please give another round of applause for that. Thank you. Thanks a lot. So we'll just have 2-3 questions. Vaibhav, so glad that you touched upon on such a very relevant topic in such a non-technical way. And so humble.
The audience should, the tagline says it, simplicity is the best way to invest. I'm okay. If they can hear, I'm okay.
Great. So that will bring me to my first question. So do you think boring investing is the best investing?
So like I said, if you make it simple and if you make it very boring, I can tell you you'll make a lot of money. And like there is a beautiful saying which Warren Buffett had put, invest as if markets are closed for 10 years. Buy good businesses and good mutual fund schemes and just hold them for 10 years. And when you will see the NAV, maybe your family will thank you. Okay, you have created wealth for their entire family. So keep it very simple, keep it boring, but keep it investing for long.
Great. So I'll tell you the background behind this question. So as a wealth manager, we come across many clients who are addicted to calls from their advisor. Sir, ye khareed lo. Sir, ye bech do. And it's very tough to convince them that this is not the way of investing into the market. This is just playing into transactions again and again. Next question, another,
Can I add one thing here? I started my business in broking, my job in broking, and I'm a pure Jain. So first thing I did was leave the job because I understood in that company that the only person who makes money is your broker and client never makes money. So I'm sorry, but this is what I felt कि उसको मजा आती है अगर आप बाय करोगे और सेल करोगे और वो क्लाइंट को मजा नहीं आती है आफ्टर अ पॉइंट सो idea is don't listen to too many advice which lets you change frequently. Stick to your investments with a goal, keep it simple, and don't, like you said, don't listen to too much advice. Simple rakho.
Great. Another question, one of the most common biases that we face amongst investor community is confirmation bias. And when it comes to confirmation bias, the common example is if I want to buy Tata Motors, I will start looking for reasons which are good for Tata Motors. But do you think it works other way around also? If I don't want to invest into the markets, I will start looking for reasons not to invest into the market.
Excellent question. So, when you want to actually make investment, listen to someone who will give a contrary view to yourself. So husband can listen to wife. ठीक है? Always you will have a different opinion. In most cases, or wife should listen to husband. Right. So when I go for shopping, I say this curtain is good. My wife says no, this is hopeless. Buy this one. And finally which one we have to buy. So idea is confirmation bias forces you to listen to people you want to listen. Start listening to people who are independent, who have no bias in what they are suggesting. And that's where you will actually get the real advice. Where there is no, but that's why maybe I didn't show any of our funds because finally you will say, ये तो कुछ बेचना है. Idea is that हम कुछ बेचने नहीं आए. Whatever he has to be bought, he'll tell you. But talk to people who give you independent advice. And that's where you will figure out whether you should actually, invest or not invest.
And my last question from my side, do you agree that for market returns, more than IQ, it's about EQ?
I can only say that if you see Warren Buffett, his wealth is $100 billion. $100 billion को मैं अगर convert करके बता दूँ तो 8,50,000 crore. Zero count करने पड़ेंगे. 8,50,000 crore is what that one person is worth. Has he made money because he is far intelligent than all of us? I don't think so. Maybe he's made that money because he is more disciplined than all of us. And that actually is the first thing that I want to say. Second, Warren Buffett, if you want to see his life, he didn't make large money till he was maybe more than 50 years old. So even if you are old, doesn't mean you cannot make a lot of money. He started making more money only once he crossed 50. बोलते ना, once you have white hair, then you will have all the experience. Beauty of market, it always teaches you something new every day. And I believe that continuing the same thing, it doesn't require too much intelligence to invest in markets. You should be intelligent, but you should be most disciplined. And that will create more wealth than being intelligent. That's personally my view.
Thank you, thank you. Now we'll open for audience for any Q&A. Yeah, I can see.
Please,
two
no
hands.
difficult questions.
So I have kind of a small question, which is that when we say that we should hold into the market, but let's say I have some investment in which I am seeing that there is a downtrend going on, and it's a strong downtrend. How can I be sure that there isn't some insider information which is not causing this downtrend, and like how do I get over that fear?
See, let's take an example that maybe you are a business person, right? And your business is going through a bad cycle. And every business will go through a bad cycle. Now, it may be that business cycle could have been impacted for 1 year, could be 2 years, could be 3 years, could be longer. When we invest in markets, essentially what you try and do is you buy businesses where you know that the business is addressing a large opportunity. मतलब वहाँ पे growth है. Right? And you invest in companies where you know कि management or corporate governance अच्छी है. If a business is going through a downturn and business अच्छा है, management quality अच्छी है, I think so that business normally should come back. If business itself is bad and the management itself चोर है, तो first तो डालना ही नहीं चाहिए. But then if any of these two things change, then you should exit immediately. Don't even look at the price. I'll tell you a beautiful saying someone had told me, and I'm repeating this, again not my intelligence. He said कि आपका cost price क्या है? Someone asked आपका cost price क्या है? He said yesterday's closing is my cost price. So it doesn't matter if you had bought it at 100. Okay, today's the price is 50. Assume your price is 50. And then assume will you buy it at 50? If your answer is no, that you will not buy it at 50, then sell it at 50. So just see if the business and management remains intact, then continue with that company.
Great. Satyam?
So first thing, the point that you said that you should pledge your... Hello. Yeah. So the first point that you said that you should pledge your money to some life goals, that was actually an excellent point, and it was a very key insight for me. But my question is, you said that Warren Buffett was more disciplined and that's why he made a fortune. But I saw a money-related documentary on Netflix on retirement, which said that you are not very attached to your future self. Like you identify your, like let's say I am 24 now, I identify Satyam in like his 50s as a different person. I'm not very emotionally attached to that person. So I won't be taking a lot of care for that particular person, and that is a fact with all of us. Now, my constant dilemma about investing is that I want to become an entrepreneur, I aspire to become an entrepreneur, and when I think about investing, I just see it as a hobby. Let's put some money. I don't see that I want to make a fortune with this small investment that I'm making. I want to take a bigger risk by doing entrepreneurship, by making a startup in next 6-7 years, and then trying to make money out of that. So that is my dilemma between investing small money or not investing it at all and not putting my mind in that direction and looking for a bigger picture.
So let me try and answer that, and hopefully you become an entrepreneur, because India needs entrepreneurs. And hopefully if you do become a successful entrepreneur, then we will invest in your company, right? So, yeah, so the idea is that we should be investing in companies of people, entrepreneurs, who are doing very well. Now the question is, it's not a question whether the money is small or large. Question is, can I give it time? If you cannot give time to your investing, leave it to someone else, leave it to them. But always one beautiful thing is diversify yourself. So don't keep all your eggs in one basket, is something that we've heard for ages. which means don't invest all your money even in your own business. What if that business goes through a downturn for 2-3 साल आपका business अच्छा नहीं किया तो कहाँ से पैसा लाओगे? That's where your stock markets and other investments can help you fund that. So create a separate parallel line of money and leave it to an expert, maybe like them, to tell you where to invest. So you need not decide where you should invest. You should only invest in the right manner, which they can tell you. And India needs entrepreneurs, so put in all your efforts to become an entrepreneur, and hopefully if your company becomes successful, all of us will invest there. So both can coexist. It's not either or, both can coexist. I'll tell you, Reliance Industries has a treasury book of 100 lakh crore. 1 lakh crore, sorry. 1 lakh crore, and they have an entire treasury team deciding on their investments. So some income he cannot invest in their business. So they decide where to invest. So even a businessman will always have free cash flow and he has to invest someplace. And you cannot endlessly invest only in your company. You need to diversify that risk. So leave it to an expert to do that for you.
Great. Thank you for such an interesting session, Vaibhav. May I now request our esteemed investor, Mr. Vinay Sankhe, to confer a small token of thanks to Vaibhav for such an interesting session. Thanks for being so patient. We just will take another 10 minutes for conferring some tokens, and then we can, start for high tea. Over to Srishti.
Thank you, Mr. Shah and Ankit. I request, as the day coming to an end, we would like to felicitate the people who have always trusted us in our journey and have showed belief in us and supported us from the day we started this journey. We want to sincerely thank our investors, clients, employees, and partners without whom we couldn't have come this long. We want to first thank our angel investors who believed in us at the time when we just had an idea and a dream to start with. Thank you for believing in us. Now, I would like to invite Mr. Vinay Sankhe to please receive the award. And I would like to invite Mr. Vaibhav Shah to please felicitate Mr. Sankhe.
Sure, no problem.
Now we want to thank our partners for their support. I would request Mr. Vaibhav to please present a token of love to Mr. Harshal Sangvi from BSc for being an amazing pillar of support. Now, I would like to call upon stage our esteemed CA, Mr. Shubham Patel, for always being our valued advisor. Thank you, sir. Now, I would like to call Mr. Indradev ji to present a token of love to Mr. Abhishek Chandlia for all the lovely designing. Thank you, sir. Now, I would like to invite Mr. Nikhil Kapadia, sir, to please felicitate Mr. Rohitash Chand for such a great product advisor. Now, we want to thank our employees who have worked tirelessly day and night, proved their excellence, and helped us achieve this milestone. I would request Mr. Krishna Mohan Atri, our lead angel investor, to present awards to Mr. Employee. I would like to call upon stage Namrata Ratnani to receive the award. Now, I would like to call Aishwarya Tandel to receive the award. Sir, now, I would like to call upon stage Ms. Sakshi Pandey to receive the token of love. Thank you, sir. Thank you, everyone, for making time on Sunday and humbling us with your presence. We hope that you have enjoyed the event as much as we have enjoyed conducting it. At Wealthy Nivesh, we believe in building strong relationships with our clients and emerge as their most trusted wealth partners. Also, do provide your feedback on the event so that we can improve your experience the next time. Thank you so much. Now, I would like to call Ankit to give a speech.
Thanks a lot, everybody, for coming, and I should really appreciate for staying back with us for such a long session. Thanks a lot again, and we can now carry on for high tea and networking. Thank you. Thanks a lot, everybody.